So I thought, well, what if I could find a digital gold, which was better gold than gold, something that is better than gold, but also a big tech monopoly? And here are my three criteria. I want it to be a better gold than gold. I want it to be a big tech monopoly, and I want no one else to appreciate it. I want it to be underappreciated. And that's what Bitcoin was in the second quarter of 2020. No one thought it was an institutional asset, even though Amazon stock had doubled in the second quarter. Bitcoin was trading about the same as it had been trading in 2018 or 2019. It got up to 10,000, it had smashed down to 4,000, it was back at 10,000. So I looked at it and I said, well, based on all the information, you would think that a digital property network or a global digital money network is more valuable, knowing that people are losing confidence in currencies, losing confidence in central banks, losing confidence in governments. And this is a non-sovereign, open, decentralized system.
Don't forget to subscribe, crypto traders. Let's continue with the interview and the analysis of this one.
Bitcoin has emerged not just as a cryptocurrency but as a symbol of digital gold, embodying a store of value akin to its physical counterpart. Yet, this status was not always universally recognized, and its journey to mainstream acceptance is a testament to its underappreciation in the past. As we reflect on the second quarter of 2020, a pivotal moment in the narrative of Bitcoin unfolds. It was during this period that Bitcoin began to transition from a fringe asset to an institutional grade. Despite this transformation, the broader public sentiment regarding Bitcoin remained tepid at best. Indeed, the prevailing perception at the time was one of skepticism and indifference towards Bitcoin's potential as a significant financial instrument. While some recognized its technological innovations and disruptive potential, many others failed to grasp its intrinsic value, dismissing it as a speculative novelty rather than a serious contender in the realm of finance. Amidst this skepticism, Michael Saylor emerged as a visionary figure who saw beyond the surface-level fluctuations of Bitcoin's underlying technology. His foresight extended beyond the mere appreciation of Bitcoin as a speculative asset. Rather, he perceived it as a cornerstone of a global digital monetary network.
Bitcoin represents a paradigm shift. It's the digital transformation of money, property, and energy. And paradigm shifts are so profound that you're staring at them and you don't realize they took place because your worldview is constructed based upon a bunch of assumptions that you've always taken for granted. And so what Thomas Kuhn says in the structure of scientific revolutions and what we study at MIT is there's only two circumstances under which people willingly undergo a paradigm shift. And one way is you wait for the old guard to die. And the millennials they get it because they're different. And Einstein, said God does not play dice with the universe. Einstein never liked quantum theory. You could be a brilliant person, but you won't embrace the paradigm shift while you're alive in the absence of a crisis.
Bitcoin challenges conventional notions of currency and ownership. It operates on a decentralized network, free from the control of any single entity or government. This decentralization is not just a technical feature, but a philosophical departure from the traditional centralized systems that have long governed our financial world. With Bitcoin, ownership is no longer bound by physical limitations or intermediaries. It is democratized and accessible to anyone with an internet connection. Paradigm shifts, such as the one Bitcoin represents, often unfold subtly, gaining momentum beneath the surface before bursting into mainstream consciousness. They reshape our understanding of the world, redefining norms and expectations in ways that can be both exhilarating and disorienting. Like the tectonic plates beneath the Earth's surface, these shifts exert immense pressure over time, eventually triggering seismic changes that reshape the landscape of human experience. Yet, despite their monumental impact, paradigm shifts often go unnoticed until they have already taken hold. They operate on a different timescale than our daily lives, unfolding gradually over years or even decades. It is only in retrospect that we fully appreciate their significance, realizing that what once seemed radical and fringe has become the new reality. Historically, paradigm shifts have been catalyzed by moments of upheaval and disruption. Whether through the passing of generations or the crucible of crisis, these transformative moments force us to question long-held assumptions and adapt to new realities. In times of war, economic collapse, or social upheaval, the need for change becomes urgent, propelling society toward new ideas and innovations. In the case of Bitcoin, its ascent has been fueled by a combination of technological innovation, economic uncertainty, and a growing disillusionment with traditional financial institutions. As trust in centralized authorities wanes and concerns about inflation and currency devaluation mount, Bitcoin offers a beacon of hope, a digital safe haven immune to the whims of governments and central banks.
The second way you get paradigm shift is a war. When there's a war and there are bombs dropping from above, you don't believe in atomic power, but then someone drops a nuclear weapon and the city evaporates, and all of a sudden you become a believer and you reassess your priorities. Even when it's 10 times better, what you have is a commercially successful venture. But for example, Warren Buffett never invested in Microsoft, and Warren Buffett never invested in Amazon, right? Even though it's 10 times better, right? If you have enough money and enough power, you can ignore. Financial assets were having the best year ever. People had great years. I mean, a lot of these hedge fund managers, they had the best year of their life in 2020 or 2021. Yeah. And Main Street assets were having the worst year in 30 years. And I had a company with $500 million in cash that was dead money. It was idle. It was generating 0% interest. The Federal Reserve said, we're not going to raise interest rates for 4 years. The company's stock was in the tank. At one point, in essence, when we were going through this, our company was valued at $60 a share in cash and $60 a share in the software business. And that was like 1 times revenue. And so, I looked at the world and I said, if the cash is dead money, and if our stock is viewed as dead money, we've got a choice between a fast death, a slow death, or we ride out of the castle and we take a risk. Okay, the fast death is I just give the $500 million back to the shareholders in a dividend or a buyback. Now, I knew that wasn't going to save the company because I'd been buying back the stock for the last 5 years. I bought $300 million worth of stock back or something. And the only thing that would happen would be the stock would go from $120 a share to $60 a share. And then all the stock options, the employees would be underwater. Then all the employees would get headhunted away by Amazon and Google and Facebook, and then we wouldn't be able to compete with Microsoft. And, we compete against a company which has more power than God, right? Microsoft, right? Every company on earth is their customer. They're more powerful than all but about a handful of countries on this earth. And they can do whatever they want, wrap it into their product, give it away for free if they want. So the challenge of giving up the capital was first we'd lose our financial capital, and then we'd lose our human capital, and then we'd have no reason to exist, and the company was going to zero. So notwithstanding whether you care whether a company lives or not,
decisions surrounding investment often navigate a complex landscape of risk and opportunity. One such notable example emerged when a company found itself at a critical juncture, grappling with stagnant cash reserves, dwindling stock values, and the ominous specter of talent flight to industry giants like Amazon, Google, and Facebook. With $500 million in cash sitting idle, yielding negligible interest, the imperative for change was undeniable. In response to the pressing need for reinvention, the company embraced a daring strategy, investing in Bitcoin. This move, while unconventional, was not born out of reckless abandon but rather from a sober recognition of the existential threat posed by inertia. In a rapidly evolving market ecosystem, where innovation is the lifeblood of survival, the company understood the imperative to adapt or face obsolescence. By allocating a portion of its cash reserves to Bitcoin, the company embarked on a calculated gamble aimed at injecting vitality into its financial portfolio. Beyond the allure of potential returns, the decision to embrace cryptocurrency symbolized a bold departure from convention, a resolute stance against the inertia that threatened to engulf it. In essence, the investment in Bitcoin was not merely a financial maneuver but a strategic declaration of intent, a proclamation that the company refused to capitulate to the forces of stagnation. It represented a willingness to confront uncertainty head-on, to chart a course that defied the gravitational pull of mediocrity. While the decision undoubtedly carried risks, it also bore the promise of rejuvenation, a beacon of hope in an otherwise bleak landscape. In a world where complacency is synonymous with extinction, the company's embrace of Bitcoin embodied the audacity of innovation, a testament to the indomitable spirit of enterprise. In hindsight, the decision to invest in Bitcoin may be viewed through various lenses, some skeptical, others optimistic. Yet, irrespective of perspective, its significance lies not solely in its financial implications but in the ethos it embodies, the ethos of resilience, adaptability, and unyielding resolve. In the annals of corporate history, the story of this company's foray into cryptocurrency may serve as a poignant reminder. A reminder that survival often demands more than prudence. It demands the courage to defy convention, to embrace change, and to navigate the turbulent currents of progress. As the company charts its course into an uncertain future, one thing remains certain: in the crucible of innovation, amidst the crucible of change, the spirit of enterprise endures, a beacon of hope, a harbinger of possibility, and a testament to the immutable truth that, in the relentless march of time, those who dare to dream are the architects of tomorrow.
I didn't see it in the interest of my shareholders to watch the stock go to $60 a share and then watch us slide. We'd have to sell the company. So the second strategy is hold the cash, but the cash is, cash trash. Ray Dalio says that is generating 0% interest. And the money supply expanded by 20% a year for the past 2 years. You can see it in U.S. single-family homes, which shot up 40% in price. And so if the money's being devalued 20% a year and you're generating 0% interest, you got a negative real yield of minus 20%. And I did the math in my head and I concluded that pretty much the $500 million in purchasing power would be cut into $250 million of purchasing power in 36 to 48 months. So that's a slow death. I could use cash to pay my employees, but ultimately we were sitting and mired. And so that doesn't work. And so in that situation, we decided we should do something transformational.